Hello everyone. I would like this video to help you with your modules 1 through 3. In this module, you will be reviewing concepts that I think are essential for your success in the course. We're going to talk about the accounting cycle. We're going to talk about how to create various types of journal entries in the accounting cycle and how we use that cycle to close out our books and prepare our adjusting entries and our trial balance. In this session, I want for you to see that we're going to talk about the accounting cycle. And again, this is a prelude to module 2 and 3, but I really want to get you started because I think it's absolutely essential you understand exactly what you're doing and why you're doing it. We're going to create some journal entries. I'm going to insert a video to show you how to prepare some very common journal entries that you will most likely see when you're going through your project and also your homework assignments. We're going to go into details, the accounting cycle, what it means. We're going to not just look at it, but we're going to actually talk about step by step and the type of entries and transactions that you do in each step. We're going to talk about adjusting entries, what they are, why they are important, and some common journal entries that you have to adjust, you have to create when you're closing or you're ready to prepare your financial statements. We're going to talk about the closing. And again, various examples and some questions at the end. Hopefully, this would be very useful to you. I highly recommend you looking at this video once, and then as you're going through various sections of your assignments, going through it again, just to reiterate some of the concepts to help you and also to assist you. The accounting cycle is very important, and you're going to write a report about this, as a matter of fact. So get used to this cycle. It's very important to note. We are going to start with collecting and analyzing data. How does organizations do that? They do it in a number of ways. They actually look at various invoices, an invoice that comes in. That's analyzing data. What happened? Analyzing the information that you received and making a determination whether or not the entry needs to be recorded. And in accrual-based accounting, we have some questions that we can ask ourselves. Do we journalize the transaction? Well, have we incurred an expense? Have we earned revenue? Have, the earnings process, has that been complete? We have to ask those questions because that tells us from generally accepted accounting principles whether or not we record the transaction and, again, how the transaction is recorded. So once we determine we need to record the transaction, we journalize it. And we're going to go through a lot of journal entries in this course, so I will definitely be demonstrating that later on. So once we journalize a transaction, we're actually creating a debit and a credit type of transaction. We're going to post these transactions to a general ledger. Now, in this case, we are recording things to a general ledger. That means it goes to a specific account in a purchase journal or accounts receipts journal or some other type of journal. So we're going to record those transactions in our general ledger. We are going to prepare unadjusted trial balance. A trial balance is solely for the purpose of creating financial statements. But our initial trial balance is really compiling all of our accounts in debit credit format. And our trial balance has a very unique capability. It gives us all of our transactions and it summarizes them by account, and it does give it to us in debit credit format, so it doesn't violate our as our debits equal our credits. So if you are preparing your trial balance, that's one test to determine if your trial balance is accurate. Does your debits equal your credits? Then you go back and you record your adjusting entries. Now remember, the adjusting entries we're going to talk about in detail later, but again, that's an essential part of the accounting cycle. Once we prepared our journal entries and we posted them to our trial balance, we can then say adjust it. We can take our unadjusted trial balance, add our adjustments or subtract, and to create our adjusted trial balance. And then now we're ready to prepare our financial statements. And as you know, financial statements includes our statement of our income statement, our income statement, our balance sheet, which is a statement of financial position, and our I'm so at a loss for words. I'm so sorry. Our statement of retained earnings, our balance sheet, our income statement, and in some cases, our statement of cash flows. I don't know why my words just lost me for a second, but so once we prepare our financial statements and they're complete, we can now close our accounting records. Remember, closing the books is only going to be closing the temporary accounts, accounts that do not have but one accounting cycle in balances. And that's going to be our retainer and, sorry, that's going to be our income accounts, and it's going to be our expense accounts. And if you have any dividends, you're going to be closing that also. So our temporary accounts will be closed, and we will prepare thus our post-closing trial balance. In some cases, they may be some reversing entries, but not always, and that would be our final step, and then the accounting cycle starts all over again. Remember, debits must equal the credits. This is our accounting equation, which you should be covering within your chapter 1 and 2. Assets equals liabilities and equity. It's very important to see when you're looking at this, when you have a liability, an obligation, when you have equity or some type of equity account, you have to remember also that to make those numbers go up or down, a debit or credit is going to be quite important. So don't think of a debit as increasing and don't think of a credit as decreasing, because that's not really necessarily true, depending on the account. So your job would be then to determine if it's an asset account. If I want to increase it, I will debit it. If it's an asset account, if I want to decrease it, I will credit it. This particular slide is very, very helpful for students, particularly as they're learning how to understand the relationship between assets and liabilities and equity, and how to increase them when we're preparing our financial statements or when we're preparing journal entries particularly. So remember that. So how do we record our transactions? How do we analyze them? We have to think about what's occurring, what actually occurred. If we don't know what occurred, it's very, very difficult to determine what accounts are affected by that transaction. So get an understanding of what's going on in the transaction. And reading the analysis that's given to you is going to be important, because it does give you a lot of good, helpful hints to do that. So my step 1 would be read the transaction very carefully. Try to identify 2 accounts, at least 2 accounts that are most likely affected by the transaction. And then using your knowledge of assets equal liabilities and equity and how those accounts go up and go down, you can then have a good shot in preparing the journal entry accurately. Now, before we go into preparing adjusted entries, I do want to make clear that I want to do a demonstration, which I will insert right here, of how to record transactions. Here is a demonstration of how to create journal entries. When you are looking at the journal entries, particularly as it relates to your project or any of your homework assignments, it's very important to understand exactly what's happening and how that transaction is affecting the general ledger. When we look at these entries, think about what is going on with the transaction, exactly what accounts that may very well be affected by the transaction, and then think about how these transactions are either debited or credited and why. For example, the first entry for the Modern Designs organization, they have a number of transactions for their first month of business. They have, on several days, they have quite a few transactions, and we're going to go through each one of them. First of all, Chris, the owner of this particular organization, invested in the company and purchased $36,000 in common stock. Now, first of all, we are recording the transactions from the perspective of Modern Designs. So Modern Designs received money for stock, in exchange for stock. So we're dealing with cash and we're dealing with common stock. If we remember, cash is an asset to the company, the Modern Designs company, and common stock is an equity item. So with that knowledge, I'm going to increase my cash for Modern Design of $36,000. I'm going to debit that. I'm going to also increase my common stock, and I increase my equity with credits. This is recording the purchase of common stock, or recording the sale, actually. Now, November 1st also has another transaction, paid rent for the month of November. So we have a rent expense. We incurred a rent expense. Now, how do we know to record rent expense as a debit? Well, if you think about it from the accounting equation, a rent expense, or any expense actually, is a decrease in equity. To make the equity go down, we have to debit it. That's why we debit the expense. The next entry is purchase office equipment on account. This is very important. Equipment is an asset. We're going to increase the asset by $16,000. But what we also need to note is we did not pay cash for this. So I'm going to say accounts payable. It didn't tell me that it was a note. It just said we paid it on account. So I'm going to assume, barring any other information, purchase of equipment on account. Now, I'm going to go back and make certain I put in my dates. Now, remember, these dates are kind of important because when you're recording these transactions, you have to make certain that you record them in the appropriate period. So don't forget that, even though I had to go back and do it. November the 10th, we have a transaction. We purchased supplies for cash. Now, remember, the purchase of supplies in this case is an asset to us. It's an asset until it is used. So we need to record our supplies asset for $1,860, and we pay for that with cash. Now, the next entry is on the 12th. Receive cash for job completed. When you and I receive cash, we're increasing it. I mean, that money went into our bank account. So $8,000 went into our bank account. And for a job completed, this is letting me know services revenue maybe that we've earned this. We performed the job and we got money for it. Record sales for job completed. See, the entries really are important to know what's actually happening, but it's more important to know what the relationship is. When we're talking about assets and making assets go up, we have to talk about, well, if I know I'm going to increase my asset, I already know I'm going to debit it. So the other side of the entry, meaning we have to have two sides of the entry that have to equal, because we all focus on double entry accounting, which you talked about in your chapters. So if we know one side of the entry, we're very, very close to getting the other side. So in this case, as I analyze it, I know I received money, and a job lets me know that's revenue. And all we have is the dollar amount. So we really have a lot of information. So it's important when you're looking at the transaction, try to pull out of that transaction the two variables or the two different accounts that may very well be summarizing what has actually occurred. So on November the 15th, we are going to pay premiums on property and casualty insurance. Now, definitely we want to make certain that we show we paid something. Whenever there's something being paid, you have to assume, unless it's telling you to the contrary, that cash went out the door. But we paid annual, so we paid it in advance. We have not used this insurance yet. We're paying for 12 months worth of insurance. So I'm going to put on here, payment, record of insurance. Now we have two more transactions. November the 23rd, we are recording jobs completed on account and sent invoices to customers. Very important to note, we've earned revenue. So I know for a fact that we have sales revenue, and we're going to increase that revenue by $15,500. But we didn't get any money for that. So we're expecting something. I'm going to say we're going to expecting a receivable from our client. And it didn't give me the name of their client, so I'm just going to put accounts receivable, $15,500. Record. Gosh, I'm trying to move my cursor. Record sales on account. Then the last transaction on the 24th of November, record an invoice for truck expenses to be paid in November. So I'm going to call this expenses. I'm going to say truck expenses. Or we could say auto expenses, but I'm going to say truck expense. And it's a 1,250 because, again, this is a reduction in equity, but we did it on account, so we're going to pay this later. And because it didn't tell me it was some kind of interest-bearing note or something, I'm going to put it into accounts payable. And so record truck expenses on account. And here you have it. Transactions that we recorded for the month, looking at each one of the account transactions and identifying the various activities that may very well be relative to the transaction. Your job is to be able to look at the transaction, try to see exactly what's going on so they can help you identify the accounts affected. Thank you very much. And any questions that you might have, please, please, please let me know. We can go through those individually. So now that you have your entries recorded and you know exactly what's going on, you can prepare a trial balance, a unadjusted trial balance. And let's look at what a trial balance looks like unadjusted. Once all of the entries have been recorded and they look fairly good, you can compile a trial balance, and a trial balance does give you the specific accounts and their total in debit credit format. And this is the first step in creating, or in the first step in your job to prepare the financial statements. It is not the financial statements yet. You still have to do some other steps, but this is the first step in that. So once we record all our transactions, we now are able to create our unadjusted trial balance. And as you look here, the trial balance has a debit and credits that equal. I know this number, the 764, it kind of cuts off, but the debits equal the credits. Trust me. And it would be a good idea for you to test yourself. If you see your trial balance does not agree, there's something wrong. You need to stop, go back and fix something before proceeding forward. So step 4, recording adjusting entries, is you're going to have to make certain that you have specific transactions that have been, or expenses that have been incurred, but you have not paid them or you have not recorded them. That's the first step. Then you have to recognize in any earned income that that occurred in a period for services that you performed to your client, but you have not billed them. Now, the word recognize means record. Recognize and record, recognition and record are exactly the same. When you recognize something, you have to record it. When you recognize it, or when you record something, you are recognizing it. So remember, you recognize your expenses, you got to record them because you have not been recorded on your books. You know that you incurred an expense, you're going to have to show it. And that's one criteria for an adjusting entry. Number 3, record expenses that have been paid but not recorded on the books. And again, those are bank fees and interest income, expenses and revenues. So remember that. Those are also transactions you'll have to adjust. Depreciation is one type of transaction. You have to show the use of an asset. In this case, a long-lived asset, an asset that has a lifespan that extends beyond 1 year. So you have to show that I've incurred an expense. I've used my asset. In this case, my asset is called equipment. So we're going to have to record that as an adjusting entry. So again, here we are. The use of supplies. Again, we're using your supplies. When you purchase your supplies, it's an asset to you. But when the asset is being used, it becomes an expense. And here is an example of what how you would record a typical entry of showing the use of an asset, as is called office supplies. When you have earned your income and you have not recorded, nor have you billed your client, you have to show that on your book, because the rules of accrual-based accounting shows that if you've earned your revenue, you have to record it in the period that you've earned it. And this is an example of an adjusting entry that have to be made to show recognition of earned income. And here we got another entry. Again, these are standard entries in the real world because sometimes you don't know what your bank fees are until you receive your bank statement. So again, this is something that you have to show an expense that you've incurred because you've had a bank account, and you have to show that on your books as an adjusting entry. And the same is true for any interest income that you've earned from your bank statement. So here is an example of what an adjusted trial balance looks like. First two columns you see are the unadjusted items, and they all agree in total. Assets equals the debits equal the credits. But then you'll also see in the columns here where you have your adjusting entries, and then you have your ending balances. Again, we're going to be taking out debit, netting the adjustments, and coming with an overall debit or credit balance. Remember, you're not going to see a debit balance and a credit balance in any account. It's going to be either or. It's very, very important to do that. It's one of the errors that I've seen most often with students. They'll show me the adjustments, but then they won't net the number into either a debit item or a credit item. So that's very, very important to do that. So the next step then is allowing you to prepare your financial statements. Now, in this course, and in any course, your first statement that you'll have to create is your income statement or your profit and loss statement. Your profit and loss statement is created first, and then you will be able to create your statement of retained earnings. And then finally, you create your balance sheet. So your balance sheet should be the last statement you create. So your statement of retained earnings is going to be done after you do your income statement. So income statement first, which will give you your net income. Then you create your retained earnings, which you'll obviously need to add in your net income, any dividends to get your ending retained earnings. And thus you will have the information you need to complete your balance sheet, which would be the equity section here. So income statement first, statement of retained earnings second, and balance sheet will be last. Once your financial statements are completely done, now remember, statement of cash flows is part of the basic financial statements, but for purposes of this course, we're not asking any student to prepare that as part of the project. But you still need to know that your total basic financial statements includes statement of retained earnings, balance sheet, income statement, and statement of cash flows. But once your financial statements are complete and they're done, you are now ready to close your books. Closing your accounts are going to be only the temporary accounts which affects one accounting period, which is going to be your revenues and your expenses. Then you'll also have to close out your dividends if you have any. That will be closed as well. Then all of these accounts are closed to your income summary, which then is closed to retained earnings. And here is an example of a standard entry closing your temporary accounts and moving everything to retained earnings. This particular section of your course is going to be very, very important because it really takes in consideration the entire accounting cycle, and it gives you an idea of what types of transactions and what activities are done in each cycle. And I'm very hopeful that this particular presentation will be of use to you. Thank you very much for your attention. So what we're going to do at this point here is I'm going to ask a couple questions, and I want you to give you a minute to answer them. Now, what are you looking at here is a post-closing trial balance. The question I'm going to ask you is, what accounts are missing? Think about it for a second. What accounts are missing in this trial balance? Look very carefully from top to bottom, and you will see that there is something very noticeably missing. The answer is the accounts that are missing are all the revenues and expenses. So as you think about these chapters that you're going through in the past 3 weeks, be very, very mindful of what step you're in, what you're doing and why, and the concepts that are related to each one of these processes. Each one of these steps is very, very important because I think you're going to see how they are not disjointed, that they all are one part of a cohesive unit that work together. And I'm hopeful that you can use this to help you with your project and your homework. And as always, thank you very much. And if you have any questions, let me know, and I will be very happy to help you.